Hey friends, I am back for part 3 of my beginner options trading series. So just to recap, in part 1 I give a quick intro to the put credit spread structure, and then in part 2 I shared a rules-based approach to entering weekly credit spreads on SPY. I'll link those down below if you haven't seen them yet. Anyway, in that second video I gave some fixed parameters like $10 wide spread or collect 50 cents. I wanted to keep it on topic, so I focused on what to do, but I didn't really talk about why. This video is the why, and with that you can start changing some of those parameters if you like. But first, as always, a quick note that I am not a financial advisor. I'm just sharing my journey and what has worked for me. What to trade? Any underlying with liquid options. I mentioned last time that SPY has very liquid options. This means the bid-ask spread is very narrow. The wider the bid-ask spread, the more you have to give up to get filled. I always recommend starting with the mid price, but with less liquid underlyings, you'll have to move your entry price further against you to get filled, and that's a hidden cost in your trades. Let's compare SPY options to TAP, a beer company. Notice the TAP has a much wider 10 to 20 cent bid-ask spread versus SPY 2 to 3 cents. And also note that TAP is 7 times smaller than SPY, so these spreads are even worse if you magnify your TAP position up to an equivalent level. So that's why we want something really liquid. We don't want to pay too much in that hidden cost. When to trade? Weekly on a down day. Instead of entering one large trade, we break it up into small overlapping weekly entries. This spreads out our timing, so if we happen to enter at a very bad time, that's only a small part of our capital. So that's the reason to enter weekly, even though the trades overlap. Next, let's consider my insurance analogy. Imagine you're selling flood insurance to homeowners on the coast. As you'd expect, the price of that insurance will be higher right after a flood. The risk is more front of mind in your customers, and they'll pay more for it. In the same way, options premiums tend to go up when the market is going down, so we wait for a down day to enter to give us a little extra advantage. It's not a huge effect, and we don't want to skip a week, so we enter Wednesday if we haven't had a down day yet. Which expiration? I suggested 45 plus DTE. Now, in my experience, the further out in time you're selling options, the smoother the return tends to be. There isn't really a right answer to picking duration, but 45 is widely considered a sweet spot. Here's a backtest I did of a very similar put credit spread strategy, also on the S&P, using a 60 DTE entry versus a 30 DTE entry. So this is from 2007 to 2017, which is when I had data for. As you can see, the shorter duration ekes out a little higher return, but the ride can be much rougher. It's like choosing between a Ferrari and a Bentley. Both are cars, neither is better. It depends on how you value comfort versus speed. Trade construction. 2% wide spread, 50 cent credit. I like using 1% of the underlying as my width per month of duration as a minimum. So for 45 days, I think of that as 2 months, that's 2%. 2% of 440, which is the current SPY price as of July 2023. That's $9, so I just rounded it up to 10. Much like expiration, there's a trade-off between wider and narrower spreads. Using 2% also keeps our risk the same each week and avoids having to discuss delta, which some traders like. I'll talk about delta in a future video. 50 cent is the minimum credit I like to collect for a put credit spread like this one. Remember that equity options have a 100 times multiplier, so that's really $50 per spread. The $10 width is really $1,000 of risk and margin use per weekly entry. 50 cents is large enough that I expect the long-term returns to exceed commission and slippage. You could go higher. We can look at a $2 credit as an example. Your potential returns will be much higher. However, the risk will be much closer to the market, and you will have a much bumpier ride. Making this as a beginner strategy, I went for the smoothest ride possible. 5% of the width, 50 cents is 5% of $10, is also probably as low as I would go. Here I'm showing the 50 cent credit version, and you can see that the risk is quite far below the market. And then here's what it looks like with a $2.20 credit, as close as I could get to $2. Same P&L plot, so both $10 wide. I just went for the higher credit, and notice that it's extremely close to the market. So you will feel that day to day. Profit taking, 20% of the initial credit. Holding on until the expiration date to squeeze those last few pennies out is not generally worth it. Taking 80% of the credit lets us capture most of the potential profit. So in this case, we collect 50 cents, so we close at 10 cents. That's a $40 profit with the multiplier. As always, remember, not every trade is a winner, and not every trade will make the full $40. Stop loss. 200% of the initial credit. Especially for spreads like this where the credit is a small percent of the max loss, and for undefined risk trades, which we'll talk about later, I like to close at some loss level before things get out of control. If we let this spread hit max loss, it could take a long time to recover, even from a single losing trade. 200% is somewhat arbitrary. You could also use like 300%. I probably wouldn't push it beyond that. And again, it's another one of those trade-off situations. The more room you give on the downside for your trades, the higher your average profit per trade will be typically, but the more the damage will be when you actually have a losing trade. Time exit. Exit when we're 7 days out. If we haven't hit our profit or loss targets yet and we're a week out, we close the trade. The last week of the spread can be very volatile, and I just think it's worth avoiding. Okay, so with that framework in place, I think, if this is years down the road and the SPY is trading at a different level, you can reconstruct what parameters make sense for the trade. It also opens the door for modifying some of the rules. If there are things that you don't like about the trade or you want to move it in a certain direction, now you know what levers to pull to make what kind of change. So I thought we'd do some example modifications. So let's start with entering on a Monday morning. So I'm currently in the Philippines. I don't want to wake up at 3:45 a.m. to check the down day entry rule. So if I were trading this currently, I would drop the down day rule and just enter every Monday morning, New York time, which is around 10 p.m. local time here in the Philippines. I don't think the down day makes enough of a difference that I would, make myself miserable for it. Another change you could do is you could decide you don't want to deal with all this layering and just do an all-in single spread. So just enter one big position, follow the exit rules until it closes, and then enter the next position. So you'll lose some of the smoother ride that having those spaced entries would give you, but you'll also have more of your account allocated on average over time, and so returns will probably be slightly higher. Using a different underlying. So you can trade this on another underlying. As I said, anything liquid is fine. So some examples would be QQQ for the NASDAQ, IWM is the Russell Index, DIA is the Dow Index. So these would all work well. There are also pure index options, like SPX is also the S&P, or RUT is the Russell. So SPX is 10 times the size of the SPY, so I don't recommend starting with it. The main advantage of SPX are that index options are covered by something called Section 1256 in the US tax code. So that treats your P&L as 60% long-term, 40% short-term, and you get some tax relief that way. I am also not, I should add, I am also not a tax professional, so you should probably consult with one before trading SPX or RUT. You can read more about Section 1256 at Investopedia, and I'll throw a link in the description. Okay, that sums up my favorite beginner-friendly option strategy. If it was interesting, a like on this video really helps. It's a brand new channel. Thank you for following along this far. I am going to cover other strategies and topics in future videos, so subscribe if you're interested, and I will see you there.